My name is Almeen Walker, and I own First Financial of Baton Rouge, which is the anchor company of our 21 company group called WMT, which is Walker Morgan Thomas, and we have several ventures here in town. This anchor company does business consulting, tax consulting, legal consulting, etc. And speaking of legal consulting, I have to do my 10-second legal disclaimer, which is the information I'm about to give is my opinion, my professional opinion. Every business is different, so you should make sure you check with your own lawyer or check with your own accountant to make sure that you're getting good information. Speaking of CPAs, Stephen Leibowitz just jumped in from Pennsylvania. And again, as I said, with the legal disclaimer, just make sure you check with your CPA or your attorney before you take any of these actions into effect, okay? So today I wanted to talk about corporations, and there are different types of companies, different types of corporations, and there are four major categories. Some are better than others depending on what you want to do. I definitely have my opinion of which one is best, and I'll share that at the end of this. But the first company type is a sole proprietorship. That's a company that's owned by an individual. Sometimes it operates under the individual's name. Sometimes it has an actual name, but it does usually have the owner using their own social security number instead of a tax ID number. The second type of corporation is a C corporation. The third type is an S corporation, and the last one is a LLC, a limited liability company. And what I want to do is just tell you just some of the drawbacks and some of the advantages to each one. So I'll just go on and start with formation, ease of formation. Obviously, a sole proprietorship is very easy to form because you don't have any real paperwork to do. Most Secretary of States don't require you to do paperwork. You don't need to get a tax ID number. So there's really no formation requirements with it. A C-Corp is similar to an S-Corp in that it's a little tougher to file. You must file with your state. You must file with the federal government, and there are specific filing fees that are required to go along with that. A limited liability company requires you to do the same. You have to file it with the state that you're registered in, and hopefully you get a tax ID number. You're not required to have one with an LLC, but for liability's sake, you do want to have a tax ID number to separate the business from your individual assets. And we'll talk a little more about that later. So, personal liability, and a sole proprietorship is obviously the worst structure of all with these. A sole proprietorship means that you own the business, you're the sole owner of the business, and it is not a separate entity. So what that means is if you make a mistake, say you're an electrician and you rewire a house, that house, you do a poor job in rewiring it and the house burns up, the person that you did the work for can sue the business as well as you, meaning your house, your car, your personal bank accounts, etc. Those liabilities don't exist with the corporate structures, the C-Corp, the S-Corp, or the limited liability company. Now, a little side note or a slight caveat to that. There is between those companies and those corporations an imaginary veil. And that veil separates those companies from you as an individual. So you have to be very careful not to pierce the corporate veil. What does that mean? Don't pay personal bills out of your business account. Those things are very bad to do because you then intermingle the two, and you will be liable if somebody does sue you. So one of those things you want to stay away from. Next are administrative requirements. This most people don't understand and don't know. There are very few administrative requirements for the sole proprietorship. Everybody knows that. But with a C and an S Corp, you actually have to elect a board of directors and officers. You have to hold annual meetings. You have to keep records of those annual meetings. And you have report filing requirements for both the S Corp and the C Corp. In terms of the limited liability, it functions a lot like the sole proprietorship. You do not have to have meetings. You do not have to select a board. You do not have any filing requirements in terms of reporting or reportability. As for management in the company, which is the next category, obviously as a sole proprietorship, you have full control over what happens with that company. In terms of the C of the S corporations, your shareholders are going to elect a director who manages the business activities. So, anybody that's a C or an S Corp and you're just a sole individual, how do you elect a board, unless you're going to put some people that aren't involved in your business? How do you elect a director, which is going to be you, to do that? And then in terms of the limited liability companies, the members can select any structure that they want for management. So if it's just you, again, you are the manager. In terms of the term, for a sole proprietorship, if the person dies, unfortunately, while they have that, the sole proprietorship dies with them. It's gone, it's done, it does not carry on. A C-Corp and an S-Corp are perpetuals, meaning they can extend past the death or the withdrawal of a shareholder. And the same thing with a limited liability company, it as well is perpetual, so it goes on and on as well. In terms of taxation, this is the big one, and my friend Steven Leibowitz over there, the CPA, can attest to this. There is the entity in a sole proprietorship is not taxed, so you're taxed on your personal level. In terms of a C corporation, you actually encounter a double taxation. I'm sure you've all heard that term. And what that means is the company is taxed on its proceeds, on its profits, and then once those profits are either distributed as dividends or distributions to the shareholders, then they are taxed a second time. So there is a double taxation. You can eliminate a lot of that by having an S corporation. The owner would take a salary, which is taxed. And then the company profit will pass through to you on a K-1, which is like a 1099. So that passes through the same way. You can be subject to tax liability on the corporate level, though, still with the S-Corp, and that would be in the form of retained earnings, meaning the money you do not distribute out to you as an individual can be taxed once you get past a certain level. Most professional companies like accounting firms, law firms, doctor's office, the IRS views that as $150,000. Above that, then they're going to want explanation as to why you kept that much in, and you're going to get taxed on it as a retained earnings tax. In terms of limited liability tax, there is none. Everything passes through to the individual each tax year, so you can leave money in the company, you can put money in or take it out. The next thing would be the self-employment tax. You do have self-employment tax if you are a sole proprietorship. You do not have self-employment tax if you are a C corporation, although you do pay the additional taxes that we talked about. And then again, you have your salary in an S Corp is subject to the taxes for FICA and Medicare, but your distributions are not. And then finally, in a limited liability, you are subject to self-employment tax up to the limit. So there's another caveat to keep in mind. We talk about pass-through tax treatment, and that's the taxes, the incomes passing through to you as an individual. Those are the case with the sole proprietorship, the S Corp, and the LLC. With the C Corp, there are no pass-through taxes. In terms of transferability of the interest in the company, you can't transfer interest in a sole proprietorship. It belongs to that particular individual. Shares of stocks have to be transferred in both a C Corp and an S Corp. Now, there are limitations on the S Corp in terms of ownership by corporation, so that means that a company cannot own stock in a S corporation. It can only own stock in a C corporation. In some cases, there are exceptions to that rule. And then in terms of the limited liability company, you can transfer it at any point. If you want to sell the company, if you want to pass the company on to a family member, you can do that with no restrictions. In terms of raising capital for the company, this is very important for small businesses because small businesses tend to need money to operate. So if you're a sole proprietorship, an individual can provide the capital to the business. There's no problem with that. On an S Corp or a C Corp, the only way you can put money into that company is by selling stock. You sell stock to raise shares. Now, most companies that are operating as C's and S's don't even have stock certificates, don't have shares. So you want to be really careful about that in terms of putting that money into the S and C corporations without selling stock. In terms of a limited liability, the owner can put the money in from equity. They can sell interest in the business. They can do whatever they want to raise money for it. So overall, in terms of the ease of operation, the easiest one is a sole proprietorship, but man, it's got a lot of drawbacks to stay away from. In terms of the S-Corp and the C-Corp, those have difficult things that you have to follow in terms of the operations. Like I mentioned earlier, you have to have the annual report. You have to have a board of director meeting regularly. You have to have corporate minutes. You have to have stockholders meetings, etc., and minutes from all of those stockholder meetings as well. And then the limited liability company is the easiest, or is easy to operate as well, mostly because it operates a lot like a sole proprietor. So if you are following everything that I said, you can obviously tell I lean towards a limited liability company. People think they're new. They were actually started in England back in 1893, so they're very old. They've just picked up popularity in the last 20 or 25 years. Typically, I say if you want to know if it's your best taxation structure and your best corporate structure, look at the largest accounting firms in the country. 4 out of the 5 largest in the country are LLCs. They've converted to LLCs. You can't be too big to have an LLC. You can't be too small. There are certain limitations when you get over 500 employees, so you have to be a little careful as that. You have to choose certain taxation structures. But once you get to that, you can make that decision at that time, and of course your CPA can direct you when it comes to that. Just so you know, I did most of it by memory, but I was looking at this sheet that I did. This is from an article that I wrote for Kiplinger's magazine some years back, and I've posted that on the website. So if you want to go to firstfinancialbr.com, and you can click on the blogs, and it is the latest blog on there, and you can go ahead and get that and read it at your leisure. And certainly if you have any questions or need some additional answers, send me a private message. And I will be glad to answer that. And just so, I just happened to look down again. I saw Tevin asked, so all profit is supposed to be distributed at the end of the year. If it is an LLC, yes, all profit does not need to be distributed, but you're taxed on it. So you can leave it in the company if you'd like to, as retained earnings, to keep it as a cushion for whatever you want to do with that money, buy equipment or operate or advertise. But you're going to be taxed on that at the end of the year. So that's why you're not taxed again as retained earnings. Hopefully that answered your question. And it is 7:15, so I think I did better this week in sticking with the time frame. Thank you, everybody, for coming and joining us. And we're going to be doing next week another seminar, and we'll post a topic for that. So until then, we'll see you next week. Take care.